Welcome to the Broken Pie Chart Podcast, episode 367. I'm your host, Derek Moore. With me once again is Shane Skinner and Mike Snyder. All right, so we're 3.5% off the all-time high in the S&P 500. It feels like the market's down more than it is. I mean, 3.5% down from the all-time high doesn't feel like a lot. Volatility, I guess it wasn't a surprise on a Friday afternoon before a weekend with an international conflict going on. I don't know if you call it a war or a conflict. I don't know what the official term is. Not surprising, but late in the day, I think the VIX, what do we close on the VIX, Shane? 30?
Just under.
Yeah, just under 30. And then the VVIX.
VVIX shot up too. Yeah, the whole thing did. 29.49 on the VIX close there at the bell.
Yeah, and so and 140.44. And so just a little explainer on what the VVIX is. The VVIX is the VIX of the VIX. So it's measuring, much like the VIX looks at the chain of options on the S&P 500 index options, and it looks and it sees what are all the ones that have a bid. Because if it's no bid to 5 cents or no bid to 10 cents, those are included in the calculation. And it kind of looks at the implied volatility and the prices of all those, and it calculates the VIX. That's like my 2-second version of that. And then the VVIX looks at VIX of the VIX, options on the VIX. So VVIX, when it gets high, and it doesn't mean it can't go higher, but normally when it gets high like this, there's some sort of reversal that may happen. But this was really set up, I think, coming into a weekend. Not a resolution yet in the Middle East. And, stocks are just, people really weren't willing to buy coming into the weekend. So, I don't know, Shane, I'll go to you first. Like, when I look at just the VVIX and the VIX, I think it really just says the market makers are making people pay up for protection, right?
Yeah, demand for protection is high. There's a greater uncertainty right now about where the market is going to be, or at least the expected range that they expect the market to be in the next 30 days, right? And so as that's elevated, that means that it's going to typically cost more to buy protection because the expectation is the market is going to move much more, or at least there's the potential for that based on how everybody's positioned. I think that this is sort of your, I guess, classic setup of, Monday's going to come around and we're going to see, is this escalating? And at that point, hopefully we know more about what or why, or is this going to, pull back? And in the instance that it pulls back, a vol crush would be something that I would think bulls really want right now, right? With that would come probably some more certainty of what's going on in the Middle East and just globally. But I don't know. But
we're still within 3.5% of an all-time high. Like, this isn't crazy. And I'm not saying I'm not a permanent bull. I'm not a bear. I'm just saying this feels like it's much worse than it is because the market stopped going up to all-time highs.
Let me ask you, because you've been through way more of them than I have. In situations like this, is this where you get, instead of like a slow, steady bear market, like, is this where you could see a flash crash? And who knows, right? Obviously, we'll know weeks from now whether something like that happens or not. But it's sort of like, does everybody just panic all at once and then it bottoms quickly?
Maybe we started to see that forming. Like if next week is stabilizes and volatility drops and the market is just like, it just gets back to sort of normal. Maybe it doesn't go higher, but it just kind of goes sideways and volatility drops. This is what you would point to. You'd say you got a spike in vol, you got a spike in the VVIX, you see people indiscriminately selling stuff, and then you say this had the makings of a near-term bottom. And then you look and you say, well, okay, the jobs report, what is it, 90,000 decline in jobs. So I don't think that was expected. But doesn't that say that the Fed can lower interest rates because the economy is not doing as well? Then you look at oil prices, and we're going to talk about oil prices. I mean, WTI cresting 90. And although the U.S. is more of an exporter now, when this happened in the 70s and oil spiked, we were definitely a major importer of oil. Now we're a net exporter. So it's less affecting here. But does it go into inflation? So oil will show up in CPI, not core, because that excludes food and energy, or super core, which excludes housing, and some other one which excludes everything else that you want. But like Mike, I mean, to me, this reminds me of, I don't know if you remember when CNBC would have the oil price on the screen, and it would have a chart of the S&P, and it would say, okay, if oil goes down, the S&P goes up. I feel like that's the regime we're in right now until we're not.
Yep. I think oil is the primary focus, which means that the situation in Iran is the primary focus for the time being. How much oil is going to affect inflation, we'll see. I think I don't know when this will be, but once this does take a back seat, I think interest rates are going to be at the forefront again. And when and if we get those cuts, and how many cuts we're going to get. But for the time being, it's all about oil and how that's going to affect inflation and the potential to cut rates if we do see that show up in inflation more than we expect.
Mike, my thought is it doesn't necessarily matter what the economy is doing, barring some sort of an extreme. Like whoever gets brought into the Fed is going to lower rates, right, Mike? I mean,
I agree with you. I don't think any of this changes the Fed's outlook in terms of lowering rates. Trump's got his guy coming in, and I think he's got one job to do, and that's lower rates. So I don't think anything we've seen is going to change that. Now, there could be something, like you said, if the economy falls apart, or if the data changes, then that could be different. But from everything we've seen, I don't see them not lowering rates.
I mean, Shane, I think it's whether or not the market goes down when the Fed is lowering rates, it tends to be more of a coincidental thing. And of course, if markets are in turmoil, if the economy's in a recession and they're lowering rates, typically the market's going down. But the markets don't have to go down because it's lowering rates. I mean, I think they just want to lower rates because it really goes back to housing, Shane. And that's real. And what they do with curve control, whether they're buying treasuries 10 years on 10-year treasuries out further in the curve to depress rates. I mean, we saw, Shane, the 10-year, didn't it hit 390 and change this week? Correct me if I'm wrong, right? It was there?
It did. And then it snapped back up. And I think again, it all goes back to what's going on with the Middle East with oil and whatnot. But yeah, I don't disagree with you. I think that getting rates lowered will help the housing market quite a bit. And it's a target that this administration has essentially said they've had since the get-go. And I think that, like Mike said, we've got someone coming into the Fed that'll probably want to lower rates. And,
What about the 2-year, though? I mean, you mentioned the 2-year. The 2-year closed today at a yield of 3.55. It jumped higher, but the charts I see, Shane, are the ones that are showing the 2-year in a very short time frame, which looks like the yield went parabolic. The reality is we're at the same rate we were at the end of January on the 2-year. And the 2-year, of course, is a proxy for what the Fed's going to do.
Yeah, no. And the 2-year, 10-year spread right now is sitting at I think 0.56 roughly. And so, it's trading above zero. That's good, right? You would hope to see that. I mean, I don't know. I think coming back to it all, I think that a huge part of this is how what's going on in the Middle East plays out, and we'll see. You know, I think the biggest disruptor, other than oil continuing to go higher, would be that something in terms of like trade. If we started seeing more oil not traded in U.S. dollars, something like that happened, that would be obviously not great.
I mean, the immediate risk though is the ships getting the Strait of Hormuz. I mean, the Strait of Hormuz right now, from what I read, it's open, and the president has said, yeah, we'll have the Navy escort ships. But I mean, my guess is the ships don't want to go in there because of the insurance coverage.
Shipping container costs and oil.
By the way, if I'm driving a container ship, like, do I want to go in there? It's like, well, no, I don't want to go in there right now. Like,
no.
So that's going to be something, but yeah.
At what point and for how long does oil need to be high for it to start impacting the bottom line of companies, do you think?
I mean, oil is an input of everything, Mike, right? I mean, it's in so many things. So you got to think, if you're a company that is bringing in goods from China, you've got shipping container cost, you've got the fuel cost, and that goes into container cost. I mean, Mike, I think it sort of matters. Like oil, it's sort of what's the sweet spot? Like 70, where they're making enough to make it worth their while, but it's not too costly, right?
Right. Yeah, I'm thinking of a company like Amazon, you know, who, let's just say gas prices start to spike and their shipping, like their shipping prices aren't going to change. They ship for free to most people. Like, how much is that going to affect their bottom line if oil stays?
Well, no, their margins. Yeah, I mean, I think their margins could get hit, and just the cost to bring all those goods over. Although they just buying it wholesale, do their costs go up, and then they just pass it on to the consumer? Like, I don't know.
That's what I'm wondering. At what point does the consumer have to pay more because oil's up?
Yeah, I mean, I guess the other part too is when you look at so definitely input cost, those types of things. We have a midterm this year. Like, the midterm elections in November. So here's the other part that maybe some people are talking about it. I think there's an expiration date on when, in theory, and I just want to say, like, we're not being cavalier about what's going on, and people have lost their lives. That's sort of a different channel if you want to turn to that. We just think about the market angle here. So, but I feel like the Trump administration wants to wrap this up at some point. Like, would it surprise me if next month this is all done, or in 2 weeks it's all done? I don't know. But they don't want this during the midterms, right, Shane?
I don't think so. And I also, I mentioned earlier, there's a meeting with China coming up at the end of March and the beginning of April. And, obviously China does a lot of trading in oil with Iran. And so this is all sort of lined up in a manner where, in a month or so, if this squeezes us, but it also squeezes China, maybe this is a tactic or a play that's being used going into those trade talks that could play out, like you said, within the next month. I don't think that the intention is for this to get drawn out into what would be called a war, right? Right now, I think it's labeled as an operation. But I don't know. This is the last time anything like this really happened. Anything this, I think, big. I was probably in my early teens, maybe even earlier than that,
Well, I mean, during the two Iraq wars, so the first and the second, I don't know if you can call those wars or not, but they were wars. I think Congress authorized that, because wasn't that the whole they voted for it before they voted against it type deal? I don't remember. Maybe they just talked about it. But yeah, and like what was it, 90, that was the first one. The markets were upset for a bit, and then it sort of sees how things go, and they see if it's, likely to get wrapped up. I think, the challenge with this is, what does the completion mean? Like, what does that look like? And if the completion can with minimal amount of damage, you try and minimize everything, I think is what they're trying to do. But yeah, we'll see. Like, I mean, we've seen whenever stuff like this happens, my inbox gets flooded with name the company. It's usually an ETF company or a fund company, and they send the charts. Here's what happens every time there's an international conflict. And everything from 9/11 to World War I to World War II, Korea, Vietnam, and then you have any number of things. The Venezuela operation, the Falkland Islands back in, what was that, 80? Is that 81? And typically what happens, there's some sort of volatility. There's often a downdraft, and then you look at 1-2 months later, a year later, the market's up. So that's the playbook I think a lot of people are going for. And I don't know, we've seen panic yet in the markets. I don't feel like the markets have really, at least, the advisors that we deal with, we're not getting the calls of somebody wants to get out. And often, getting out and making an emotional decision isn't the right decision. You got to kind of think about the long term. But we're 3.5% down from an all-time high. I don't see panic yet. And, we'll see. Mike, let's talk a little bit about what VVIX and VIX means as far as dealer positioning. So, and I think it's worth saying that when volatility jumps, what happens? So ordinarily, you buy a put option. And here, I'll give an example. So let's say, what's the SPY today? So the SPY finished 672 spot 38. And then let's say you were going to buy, I don't know, an April 10th put, and you're going to buy the put. Give me a number, Mike, 5% down, something like that.
I like that.
Okay, so 5%. So that's the 639. Okay, that's fine. And then we say, let's imagine, now there's a dividend yield, but let's pretend these were index options. And we're going to do, the risk-free rate is right around let's say 3.5. So you would say and let's say we had that option before this dust up. So we go to a 15% volatility. So that put delta is a delta of 10. It's actually negative 10. So Mike, if I'm buying that put from you as the market maker, and I have a 10 delta, how many shares do you need to short to hedge your position?
10.
Yep, it's 10. So now let's pretend the market didn't even move and volatility just shot to 30%. Well, now that same, assuming no other changes and all else equal, and it never is, that 10 put delta goes to a 25, which means you have to do what, Mike?
You have to sell 15 more shares.
There you go. And then we say, so then you start to look at across the books of what's out there. There may be a concentration of a certain number of options that, as the market goes down and volatility is going up, you can have that delta go up. So let's say the market went down from here, it goes down to, 672 to 660. And we keep that same vol and we say, well, now it's a 32. So now you're going for a 24 to a 32. What do you got to do, Mike?
You got to sell more shares.
You got to sell 8 more shares. So now you're short 32 shares. But now let's say we stay at 660. This is the 639 put, and volatility goes back to, to 15. You had a 32 short put delta. Now your put delta is minus, 20. What do you got to do, Mike?
Now you got to buy shares back.
You got to buy shares back. And this is what I'm getting to. This is why at some point, as market makers in the position, they have to short stock. They have to increase the net short, meaning they're selling. And if this thing flips where you don't even need the price to go up in the market, you just need volatility to come down, that brings buyers in. So Mike, going through that exercise, like are we at the point now with a VVIX of 140, a VIX of 30? I mean, we'll see what happens over the weekend. But do you think this dynamic starts to come into play now that we've finally gotten up a little bit higher? Like the VIX really wasn't that high for all this week.
Yeah, absolutely. I mean, like we said, it could go higher, but typically when we see it hit these levels, and this is why you see, I think part of the reason why you see the VIX go up and down so quickly sometimes. Like it'll rally to 30, from 15 in a matter of days and then sell right back to 15. And it's these dynamics that help spur that sort of really quick change because the dealers are adjusting their books to hedge off the positions that they're taking on.
Shane, we've gone through, these dynamics are really interesting. I didn't peek to see, I guess I could have pulled it up on Bloomberg to see where the concentration of strikes is. That's what they call the gamma squeeze and all that. We'll save that for another time. But I don't know, like Shane, the fact that volatility really didn't crest like this until the afternoon today on Friday. I mean, is this what caused the selling pressure to come in? I mean, dealers sort of adding shorts.
Could have been. I mean, I hate seeing a strong surge in vol going into the weekend and trading near the lows on a Friday. I just, obviously from a technician standpoint, if you're bullish, you don't necessarily want that. But at the same time, again, this is one of those situations where as a trader, not thinking as an investor, right, but thinking more as like a trader, I don't know how many people are willing to stomach holding risk over this weekend. Me personally, trading wise, I wouldn't love to hold something over the weekend in either direction, right? Because who knows what's going to happen in the next 2 days and where this market's going to be by the time we open Monday morning, right? Things could escalate, things could resolve. And so I think we've seen it before too. Maybe whether this market continues to go up, stay range bound, go down, maybe we're in a situation where vol is just naturally going to stay a little bit more elevated until whatever happens in the Middle East is resolved.
So if I go back and I look at the VVIX spikes, it's, what is it, September? Let me just get my mouse here. Yeah, September 15th of last year, October 13th, November 17th, and then today. And in all three of those cases, well, this is a weekly chart I'm looking at. So, but in all three of those cases, the next week volatility fell off. And in fact, in the one in November, I mean, it came way off in the next couple of weeks.
Yeah, I see that one. Would you say, though, that this is different simply for the geopolitical factor? And that's where my concern really comes in, is not to be as this time different, but is that really what this is? And you mentioned earlier, if people don't start to see this affect themselves material in a way that are investing or involved in markets or living in the U.S. that are the majority of holders of the U.S. market, that's not going to probably cause much of a panic, I would think. So do you think it goes back to oil, like Mike was saying?
Well, look, I mean, we gave people the pick of the year, which is buy energy, at our end of year prediction show. We really did.
Take some credit.
Yep.
No, like we were just having a discussion, Mike, and I even joked around, like, so are you stepping in here and buying XLE, the oil? I mean, that was so out of favor. Look at a weekly chart of XLE. And we did that show at the end of December, And the next week it actually surged, and it's just gone up quite a bit. I mean, if we look there, it went from 45 to high today was 57.88. So
it's up like 26% this year.
Yeah, it's up 26%. I mean, Mike, if I told you West Texas Intermediate crude this week was up 34.3%. This is from Bespoke on Twitter. I don't know what time. I think it was this morning. I don't know it might have gone up more than this. But you look at a chart and you say, this goes back to 85. This week is the largest 1 week change upward in oil, 85 to 26. So, I mean, that's something. And like, you look at a market and the market doesn't like these things that come out. And like, this looks like silver. Look at XLE. That could be a silver chart. XLE, by the way, is the energy ETF, the sector. So, Shane, I wonder what the vol is on West Texas Intermediate futures. I guess we could look at that, or I could look at that later. But
I'm pretty sure I saw, at least at the brokerage I look at stuff on, I think I saw requirements double on oil this past week. Like the contract requirement for micro crude was something like $750, give or take. Mm-hmm. And that thing jumped to like almost 1,500. So that's another thing with the commodities, especially, that I think people forget about is the futures margin requirements and how that stuff works and how people sometimes end up getting stopped out, not necessarily because they're in the wrong position, but requirements on positioning can change. Same thing happened with the GameStop stuff. But, this is a weird spot the market sort of found itself in.
I mean, nobody wanted oil. Nobody wanted energy. Yeah. I mean, we talked about it on our show. We said, like, if you're a contrarian, you buy energy here. And is energy like this year's gold is sort of the question. I mean, it's only up 26% through mid-March, right? Or almost mid-March, I guess early March. The other thing you kind of look at is there's a chart from EIA, that's the U.S. Energy Information Administration. Okay, that's who it's from. Somebody put this on Twitter. And it's a chart of U.S. net imports of crude oil and petroleum products. And it was kind of around 2019 or so that we went from a net importer to a net exporter. And it's actually been coming down. If I'm looking at this chart, it crested 2005. So 2005 was the most number of barrels a day that we brought in, and then it started going down. And I think I know why they're putting this is they're showing this to say we don't have to, like, we're not as dependent on foreign oil as we once were. And I guess the question is, do higher oil prices affect the U.S. as much as it once did? I mean, have you seen the Korean market? Have you seen?
Yeah, jet fuel like doubled, I'm pretty sure. And then they're also selling like the data or the memory, right? Like that whole like sector over there they've had multiple circuit breakers to the downside, correct?
Yeah, no, I mean, so now I'm curious. What did I say? Oil went to 140 in 2008. And I think when was Katrina? Was that July of 2008? I'm trying to remember. Katrina was the New Orleans one. That was the big one.
Yeah. Was that in?
Yeah. So inflation adjusted price is 207.01.
Yeah, Katrina was in 2005.
2005. Okay. Hang on. All right. So if you adjust 140 to today's dollars, it'd be $233.04. Like, think about that. Inflation adjusted. Oil on an inflation adjusted basis is still pretty cheap, even if it's $95 or $90.
think the Disney pass has appreciated much more than that.
On an inflation adjusted basis, yeah, I'd probably say so. Yeah, I mean, now I'm curious. 79 prices chart, 1970s. I wonder if we're still below the 1970. Because in 1970, actually no, 79. Yeah, it was like $38. I should have done this beforehand, but that's okay. I'll just do it. So from January, let's call it 79 or 80. Let's just do it from 80 to round it. $38 would be 158.86. Like oil is still pretty cheap. I think it's important for people to remember that. And also, when you see oil prices, well, I mean, crude oil, that's one thing, but gasoline prices still have a ton of taxes on those. So I don't know where I was going with this, but I'm just always like, it's really not that expensive. It's been higher. Does that surprise you that
No.
$38 in 1979, 1980 is on inflation adjusted? That's higher today. And that was when we were a major import of oil. And that was a much greater impact back then. So Mike, to get to your original question, like when does it matter? I don't know. Maybe it can go higher.
Yeah. Yeah, it does surprise me a bit to hear those numbers. And then you kind of think through it and it makes sense. But, you know, it's higher than it was. So is it high relative to history? No, it's really not as high as the number looks to be. But, you know, it was just trading at $55. So, you know, it's going to make some sort of impact. But is it high relatively? No.
The cure for high oil prices, as they say in the business, and I didn't see this on the show Landman, is the cure for high oil prices is high oil prices, meaning, you know, a rig that was shut down, now it's economically viable at these prices to light it back up. So do we see more supply come on? I think OPEC has said they're committed to increasing supply. I believe Iran's oil was, besides China, I don't think people were buying that. It was embargoed. So I don't know. We'll see. I mean, oil is a little bit, I shouldn't say easier, but it's quicker to ramp up production than if you have coffee trees and you're like, well, let me cut down all these coffee trees, and then coffee goes really high, and you can't necessarily just go plant a coffee tree and have it be fully grown and operational. It takes years to do that. So, all right. Let's do a little prediction here. I'm going to go around the horn. And before we get to the predictions, like, don't trade off this. And I would just mention protection cost a little more today, this afternoon. And it's kind of why we say you want protection when nobody else wants it. Like you always want to be hedged, and you want to have these things in the portfolio in case things like this happen. So that's why we continue to be big fans of buying and hedging or buffering and all the sort of the core things that we do. So I'm going to say by next Friday, Shane, I'll go to you first. What's the VIX on next Friday? I'm not even going to ask what the market is. I just want to know what the VIX is.
The VIX next Friday, we're going to close at 35.
Oh, you think it's going to be higher?
Yeah.
Okay.
We're going to close
Mike,
a
how about
little
you?
bit higher, but there'll be a big up whisker.
I'm going with 23.
I'm going 17. So I'll be right or wrong, or I'll be wrong.
We
It's
hope
like,
Derek's right. We pray that I am wrong. If Mike's right, that's not bad. Well, that's probably how we'd rank that, right?
maybe we should have done it. What is it next Thursday? Because the whole Friday afternoon thing.
Yeah, I mean, I don't know. This is all
right. So Shane, what is oil by next Friday?
But by next Friday, oil is probably trading at, I think, 130 a barrel.
130. Interesting. Let me just get the official close today. So, yeah, 91.27. I believe that's WTI. Yeah, because Brent was 93.16. 130. Okay. Mike, what about you?
85.
Oh, 85. I'm going to go 75. I'm going to be wrong, though, I think. I think somewhere between you and Shane, Mike, is going to be right there. What is Murban crude? I don't even know what that is. I'm just looking at CNBC's site. I don't even know what that is.
I don't either. Do you guys think that, like, in this situation, it's not always right? I don't know the correlation between oil and the S&P. Do you think this is a situation where if oil continues to climb, like, you could see an inverted relationship here and the market continue to...
No, I think it goes back to, I mean, you don't remember this, but there was a time so it was 2005. I thought it was 08, but I guess it was 05 after Katrina. And CNBC had the chart of crude oil up all day. And it was the whole thing, like, oil's down, great, the market's green. And it would, this goes back to stuff matters when it matters. So yeah, we could be in this period where oil's down, market's up, oil's up, market's down. Because oil is almost a proxy for VIX at this point. And which is why I was sort of surprised that it took VIX this long to get where it was. Because given the move in oil, like, oil goes up 34%, I figured the VIX should be higher. But maybe, I don't know. We'll see. And then on rates, this is the interesting thing. Like, why is the 10-year spiking? You would think that if the economy is going, let's just say, play this out. Okay, if you think the economy is going down, markets are going down. We know the Fed has come in when markets go down, although, again, only 3.5% off the all-time high. So not crazy. Doesn't mean it won't get worse or get better. And, you've got energy here, but energy is a supply thing. They could make rates -1 and it wouldn't necessarily change the price of oil. So, I mean, why is the 10-year going up? Is it just they don't think interest rate cuts are happening? Like, Mike, what's your sense on this?
That's how I take it. I take it higher for longer in terms of rates. It is sort of surprising, but that's really how I read it.
I mean, 4.138 on the close for the 10-year. And you look, I mean, people forget January 25, the 10-year was, 4.78, 4.77, somewhere right around there. And if you zoom out of the chart, you would say, well, we're back to where we were in November. And we're back to where we were, October, November period. We saw them come up higher, but I don't know. Shane, what do you think? I mean, I'm not convinced. I still think the likely direction for the 10-year is actually, it's lower, but if the economy is good, normally, as we know, I mean, nominal GDP. So if you tell me nominal GDP is going to be higher, I would say, yeah, it makes sense that the 10-year is higher. And the 10-year could be higher, but the front end could be lower too. Like, we've had this flat curve for a long time.
Yeah. I mean, I also think that right now we're just seeing a lot of volatility, a lot of whipping around and a lot of things. Again, just a larger amount of uncertainty. The earlier move to the downside in the week in yields had the feeling that, like, oh, wow, like the market's like, that we have to cut. This is going to cut. Absolutely. That kind of a move. And then for us to pull back up was, I wonder if the bounce back up is sort of the way the market, the S&P indexes, if you will, sort of held this week as well. They closed down, but not by a ton. And given all the stuff going on geopolitically, the move in oil, for the market to barely have moved relative to the type of move in oil and what's going on, again, it's just sort of like everything's compressing, right? And so I'm worried about stagflation. I never lived through it. I've never seen it. I could have a incorrect understanding of it, but I think it looks like we're seeing not that we're not growing, but growing a softening, and the sort of you've got interest rates that have been high for longer, right?
This is not high though. Come on.
I mean, like, relative to where
this is really not high.
I mean, but you've got tightening credit. You got
rates were higher than this in the 90s, and the market did just fine.
We're not in the 90s. That was 30 years ago.
Well, if we get nominal GDP growth like the 90s, I mean, that's
fair.
That's something.
That would be.
I mean, here's where we are too, and just bring it back to the markets. The forward PE is now, I mean, at one point it was what, 23? Now checking on Bloomberg, it's 21.39. Like the analysts have revised their earnings estimates higher.
Are you really excited as a new Fed chair though? Say oil's trading around 85 to 100 something. Are you really excited to cut interest rates? And you've got a large.
Why does it matter though? Why does it like it's a supply thing? Like if interest rates go down by 50 basis points, does that cause inflation and energy? Like I don't think so.
Fair.
I don't think so at all. I mean, I'm still of the vein that the Fed increased rates when we had inflation, but all that had to happen is the extra fiscal money that was in the system had to come out of the system, and supply chains had to get back. I mean, people forget there was a line of ships trying to get into port in California. Shipping containers cost $10,000 a container. I mean, they were $1,500 before then. That was a supply shock. And the worst thing that you can do in a supply shock is to pour money on it. It's like pouring gasoline on the fire. And that's what Washington did with 1, 2, 3 stimuluses, PPP, rent forgiveness, mortgage forgiveness, child credits, EIL, EIDL loans, whatever they were called. Like there was so much money that got put into the system. I don't think they needed to raise rates at all. They could have kept them where they were and it would have been fine.
Right.
I mean, Mike, you may disagree with this, but it's just, it's so, I mean, people have been on the demand side in the economy for so long of far as, goods and services and demand for those things. A lot of people had never seen a supply shock.
Do you think if they would have done nothing, inflation would have come down faster? We'd be in the same place?
Be in the same place.
Same place.
Yeah. I can never prove it.
Yeah.
Do you disagree?
No, I mean, I think the inflation we saw it was different than, it was caused by different, different things going on in the world versus inflation we've seen in the past.
So the variables have changed, you'd say?
Well, I think in this scenario, the variables changed. Yeah.
So do you think that then one of the biggest risks to maybe like markets and where we're at right now, or inflation rising, isn't so much interest rates, and it's more so like if deglobalization or slowbalization, if you will, if the slowing down of globalization and global trade were to happen, doesn't that then disrupt those supply chains we were just talking about? And that in turn could cause inflation because all of a sudden you've got this reshifting of who's trading what with who. And, that's who knows when that happens, if that happens. But at that point, is that really the main risk of inflation then right now for the U.S.?
I mean, I would say that all you have to tell the White House is you're thinking about building a plan here.
Right.
Like I don't think Apple's built an iPhone here. If they have, I don't know about that. You just have to announce that you're going to do it, whether you do it or not. I mean, the regime, the current people in the White House will change. It's the same thing that it doesn't matter who's in the White House. You can always make a promise. Didn't Foxconn promise, was it Biden or Obama? They were going to build like all these plants in Wisconsin. I don't know if they ever went through with that.
Yep.
Right. Yeah.
You just sort of say it. I mean, what you bring up though is onshoring manufacturing versus getting something that's cheaper, faster, easier from overseas. I mean, I was at the CFA Society dinner in Phoenix this week, and thank you to State Street for bringing me on as a guest there to the event. And Jeff Sherman from Double Line, Cameron Dawson from what firm is she from? And Bob Elliott from PGIM. Hang on, I got to see what Cameron Dawson. She's on CNBC or Bloomberg all the time. New Edge. So they were up on a panel on stage, and then Tom Keene from Bloomberg hosted it. And it was interesting just hearing the back and forth. I mean, one of the things I think somebody brought up was, like, what are the costs if you have dual offshore, onshore manufacturing? So you have onshore to help with tariffs or to de-risk your supply chain. And then you have the offshore too. And then somebody else made a point, well, they could dial that up and down in theory. Now, easier said than done, but yeah, I don't know. All right, I think we beat this up enough, right?
Yeah.
So I'm trying to oh yeah. Shane, we already talked about oil. Shane, you were nice enough to send those charts over. Let's just go talk about the chart for a second. So you made the point, when did you break even on USO? Explain this.
Okay, so
not you personally, but somebody who bought USO. Yeah.
So if you had bought USO, it's relevant too, because this is right when I graduated, right when I came into the market, right at COVID, right? So if you had bought USO at the peak, which was basically the opening week of 2020, right that first week of January, you have not gotten back to break even if you had held that position until today. So it's taken basically 6 years. Yeah, 6 years and 2 months. So it's just fascinating to me. And I mean, that was such a crazy phenomenon and experience to live through. I was in college still, but I had started dabbling in trading and everything. And, I remember calling my derivatives professor going, how is it possible that futures are displaying, negative on my chart right now? And he's like, wondering the same thing. And who would have thought that those futures could have gone negative?
I mean, it's possible. When Tracy Alloway wrote an interesting article, I think it was during that time, where she looked into like, oh, if you're getting paid to buy a barrel of oil, like, why wouldn't you just do that? And the reason why the buyers can't come in is because there was no storage. Like, you can't just buy that barrel and store it in your house. The chemicals and everything, like, you'll end up dead.
Yeah.
And
or the government will stop that. Yeah.
Well, it's probably against some sort of permitting or laws.
Absolutely.
But I think if I find it, I'm not going to find it, but I remember she wrote this, or at least talked about on her podcast, Odd Lots, her and Joe Weisenthal, where they looked into, what if you wanted to buy a barrel of oil, but you have to store it somewhere and there was no storage. So you couldn't buy it. Because in theory, you're like, I'll rent a storage space and I'll put a bunch of oil in there. You can't do that. She also tried to ship a teddy bear in a shipping container cart in, when was that? When container rates went up, and she finally gave up. It was funny.
That's funny. I actually got extra credit for building out an arbitrage on Excel for renting space, getting the permitting to try to store oil and take delivery. And I was like, if we could just raise this much capital right now and take, delivery, we'll make this much money guaranteed when oil gets back to like 40 a barrel. It was, our professors thought it was funny.
Yeah, I will tell you, I was trading commodities a long time ago. This is probably early 90s. And they made a mistake. So with physical commodities, so let's say you buy a corn or a sugar contract. Let's say it's corn. And you hold that to expiration. Well, it converts to the physical commodity. And then you have to arrange, like, where are you going to store it? And you pay storage costs and all that stuff. I closed out back then you would just call up and you tell somebody, hey, close my contract. I closed it, but they made a mistake and didn't close it. So I get this call and the person wanted to know, hey, we just want to know where you want us to arrange the, delivery of corn. I did not want to take delivery of corn. It would have been a full boxcar volume of corn I would have had to store someplace, but luckily they worked it out. I had closed out the contract. So, but yeah, those are physical delivery. All right, Mike, anything else on this?
No, I think we covered it.
I guess the last question is the market, is it just simply multiple contraction because of what's going on? Do we just pause here? Or is the market smarter than the analyst? Meaning the market is seeing that, hey, these analyst expectations, those are pretty rosy. We're not buying it. Mr. Market is not buying it anymore. Is that likely, Mike?
That's the question of the day. I wish I knew. I mean, that's what we're thinking about when we're looking at the market is, are the analysts right? And the market's just getting really cheap. And it's like, why, if I liked it at a 23 multiple, don't I really like it at a 21 multiple? Or are these estimates out of line? I mean, it's hard to say. I mean, based on how earnings have been going and, these companies have continued to meet or exceed their earnings. And so they're hitting previous estimates. Now a lot can change and things can be impacted where they don't hit them in the future. But so far, the estimates have been continually hit.
Semis haven't retraced that much, right? I mean, I'm looking at SMH. All right, I guess it's 47 points off the high, but that chart looks different than the S&P chart. S&P chart's a little more flat. If I look at semis, I'm still fascinated, Shane, if we do get an S1 from OpenAI and certainly, I was going to say Starlink, SpaceX. I'm looking forward to that. I really hope they come public this year.
It's going to be interesting. Them, OpenAI, Anthropic, who knows who's gonna do what at this point. Whether they're going public, working with the government, both. It's fascinating to see where we're at, and I think that we're not going to get into it at this point. Maybe this is worth talking about down the road, but the disruption that AI, chicken or the egg, right? Is AI going to disrupt first and actually cause issues because it's going to make certain companies or services obsolete versus what, the technology that's made is able to provide? There are going to be obviously winners and losers on both ends of everything that AI affects. But this is where I'm wondering, do we see regulation step in? Right. And almost slow down or hinder some of the stuff going on.
Well, that's what they want. I mean, if you're an incumbent like Meta, didn't Mark Zuckerberg go before Congress and say, yeah, social media should be regulated and we'll help you write the regulations because that stops new entrants from coming in. My hot take, though, on OpenAI is OpenAI winds up being Netscape. Netscape was the sort of original browser.
I think you could see it, and that crawled so something else can walk further down the line. And, again, I saw something posted somewhere, jokingly, but someone making the argument that is AI winning, or is Apple winning the AI trade by just not participating very much and sitting back and waiting?
Well, I mean, that's the thing. I mean, Mike, if we look at Apple, they didn't spend the CapEx, so they saved that. They let sort of all these other companies spend a ton on it. They develop it. They're almost developing it for Apple for free, and they'll just come in and license something, or maybe there's a product they just buy off the shelf, or they buy one of these for scraps.
Yeah, I mean, Apple up to really this week, it's been holding up. A lot of times you see the market down, Apple's flat. Not so much this week. Apple did sell off, but Yeah, I mean, Apple is sort of just in a waiting game, it seems. There's not a whole lot exciting going on there. It seems like they're waiting for their opportunity to either buy someone who's already doing what they need or license the software. The implementation will be interesting to see how they implement it and how effective it is. But up to this point, they've just been sort of watching, it seems like.
I'd love to see OpenAI's like income statement. All right, well, we're not going to see that. It doesn't matter. And the thing is, like, I guess I can have an opinion on this because I don't have access to their financials, and somebody who's doing their due diligence of whether to invest in them is doing their own due diligence. So
do you think, Derek, we know who, like, does the company exist today that's going to be the survivor of this, or the companies, or do you think there's still new smaller companies that are going to, come from this and be the eventual winners?
There could be new companies that come in, but I kind of think it's going to be one of these.
Yeah.
So the other night at that CFA dinner, I think it was Cameron Dawson who said this. Wasn't Google was it the 7th or the 17th web browser? And that was the winner. It was it had a 7 in it. But she made that point, and it's like, yeah, that's really interesting. Because it wasn't that. I mean, Netscape was sort of the first one. So that's kind of the question to me. OpenAI, like at a $750 billion valuation, it almost feels like you have all these investors going into it. It reminds me of when someone spends so they're going to open a restaurant, they get a bunch of investors, they spend a couple $1 million building the inside out of the restaurant to spec. The restaurant's open for a while. It never really breaks even, never really can pay off the debt. And eventually it winds up just going bankrupt or being sold. And it's the next person who gets that asset that actually makes money in it. And I just wonder if that's not OpenAI. I have no idea because I don't see the financials. I just wonder, like, where is Professor Aswath Damodaran was on with Meb Faber, and he kind of made the point that Sam Altman has never really laid out his business plan for how he intends to make money beyond just subscriptions. So, all right, I think we're done. Let's go to recommendations. Mike, do you want to go first?
Sure. New season, Derek, I know you watched this one, Survivor, but you're probably not going to watch for a few months.
I won't. I watched when all the episodes are out. Yeah.
But it's great so far. Great to see some old faces on the show. It's an interesting mix of newer, younger players and people that played 25 years ago. So I recommend it. If you've ever watched Survivor, this is a great season so far.
I will watch it. I'll tell you my thoughts in like a month and a half.
Okay.
I like to watch all the episodes and I fast forward through the commercials. Sorry, CBS. So, Shane, what do you got?
I'm going to have to go with Blade Runner. My wife hasn't seen it, so we're going to watch that one this week.
The original one or the new one?
We're going to watch them both. She loves Ryan Gosling, and so I was like, look, you could watch the Ryan Gosling one, but you got to watch the first one. Like, otherwise it's just not going to add up. So, but we're going to probably do a double feature on that. And didn't Ridley Scott do those? Is that?
I don't know. I don't remember the original one. Schwarzenegger was the original one.
No, it's
Harrison Ford.
Harrison Ford. Schwarzenegger was it The Running Man?
The Running Man. That's right.
Yeah,
okay.
That's another good one. Yeah.
Okay. All right. Is that out now? Or I thought that was in the movie theater. Is that out on like Netflix?
That one was was that the Long Walk that you're thinking of that was just out in theaters too?
Yeah, I don't know. I'm all over the place here. All right. So we'll check that out. And then I have a pre-recommendation. Steve Carell has a new show called Rooster on HBO Max. It's not even out yet. It's out like by the time this podcast is out, it will be out. So I think I'm going to check that out, see what's going on there. And then, but again, HBO, come on, just give me all the episodes. Just give them all to me. And then F1 starts this weekend. It's in Australia, so I think it's on. We're recording this on Friday. I think it's on tonight, the qualifying, and then tomorrow night is the race. It's on Apple TV Plus now, though, because it's no longer on ESPN. So now I got to figure out. I have Apple TV Plus, but I got to figure out how to heck to watch this thing on there.
You brought up Steve. I love Steve. I love him as an actor. Did either of you guys watch Mountainhead? Came out last year. He was in it.
No.
Okay, it's about a group of billionaire friends that get together against the backdrop of a rolling international crisis out in the mountains to try to come up with a way they can try to help fix and save the world. It looked really good. I hadn't seen it yet, so maybe we'll have to watch that too and come back with a recommendation. He's a great actor.
All right, we'll come back next week and see how wrong we were with our predictions. Don't trade off those. And watch whatever show that Shane said to watch. I forget. Blade Runner, Running Man. I don't know. Watch those two. And Survivor eventually. Look, I'm a holdout on Survivor. I keep watching it year after year. So ever since the first season. But yeah, that's me. All right, everyone. Take care. We'll talk to you soon.